Today we're discussing one of the most explosive developments to hit the world of global currencies in many years. Reports are now spreading that two financial giants, Bank and Wells Fargo, are internally displaying entirely new exchange values for the Iraqi Dinar, IQD, and the Vietnamese Dong, VND, figures that many followers had almost given up on seeing. Whispers suggest that screens within specific foreign currency departments are illuminating, with rates showing 5.3s for one IQD and 3.95 for one VND. For a long time, investors, economists, and interested observers have debated whether a revaluation of this magnitude was even possible. Now the entire conversation has shifted from a theoretical if to a critical, is it already happening? Tonight we will meticulously dissect what these precise figures could signify, explore the process behind such internal banking updates, and analyze what a synchronized move like this might signal for the interconnected international markets. Prepare yourself, because comprehending this moment may fundamentally change your perception of global finance forever. For several months, financial analysts have been observing subtle activities within the global banking infrastructure. System overhauls, cross-border payment testing, and unusual spikes in foreign exchange data flows have attracted attention. But few anticipated any concrete evidence would emerge. Then within the last 48 hours, a significant buzz began to circulate online. Employees situated in U.S. currency exchange divisions reported noticing new placeholder rates appearing on their secure internal terminals. Initially, it was dismissed as a potential system test, until multiple bank branches across the country allegedly observed the identical figures. Suddenly, this compelling rumor was no longer confined to speculative online forums. It had entered serious professional discussions within established banking circles. When two of America's most prominent and respected financial institutions display identical, unannounced data changes, it demands immediate and serious attention. The most immediate and logical question is whether this could simply be a technical error. Large commercial banks routinely execute internal simulations that are never intended for public consumption. However, seasoned currency observers point out that simulated test data rarely reflects values that are close to realistic market expectations. In this specific case, the reported figures, 5.3 per Iraqi Dinar and 3.95 per Vietnamese Dong, are structured in a way that suggests they are genuine exchange updates being prepared, rather than random arbitrary placeholders. That critical detail alone causes many financial experts to pause and reconsider. These are not just random digits. They align with the precise type of internal calculations that would be expected if a significant, genuine global adjustment were being meticulously prepared behind the scenes. Now, before enthusiasm reaches premature heights, it is crucial to state clearly that the general public cannot yet enter a bank and execute trades at these purported rates. No official declaration has been issued by the financial institutions involved, nor by any central bank or major international monetary body. Nevertheless, when internal banking screens spontaneously change, it strongly implies a level of coordination that operates far above the level of local branches. The foreign exchange data streams utilized by major global banks are directly linked to international clearing systems, meaning that updates are typically deliberate, strictly scheduled, and formally verified. For those dedicated to tracking the long-discussed revaluation of select emerging market currencies, this specific type of movement is often considered the first, barely perceptible tremor before a major financial earthquake. To grasp the full weight of this breaking story, we must quickly revisit the historical context. The Iraqi dinar has been a focal point of intense speculation for over a decade. Iraq boasts enormous oil reserves, a constantly growing gold reserve, and significant foreign currency holdings exceeding $100 billion. Extensive economic reforms have been successfully implemented to modernize the banking sector, combat corruption, and stabilize endemic inflation. The nation's debt-to-GDP ratio remains among the most favorable in its region. With the release of Iraq's 2025 budget, which contained subtle hints of structural rate adjustments, analysts began to strongly suspect that the essential groundwork for a much stronger currency had already been completed. If an official exchange rate near $5 were to be confirmed, Iraq would instantly possess one of the world's most powerful currencies, a financial transformation capable of completely redefining Middle Eastern trade dynamics. Meanwhile, the Vietnamese Dong has its own compelling narrative of growth. Over the past decade, Vietnam has established itself as one of Asia's most rapidly expanding manufacturing and export centers. Foreign direct investment continues to surge into the country, while its export volume and gross domestic product, GDP expansion, remain robust and consistent. Economists both domestically and globally have long maintained that the dong has been intentionally undervalued, primarily kept low to maintain highly competitive exports. If the number $3.95 were confirmed as its new parity value against the US dollar, it would position Vietnam's currency closer to the strength of nations like Malaysia or Singapore. This move would essentially be an official acknowledgement of the true, underlying strength of its highly dynamic economy. Crucially, such a dramatic shift could not happen in isolation. It would necessitate substantial regional coordination and formal approval from major international regulatory systems. Observers have noted another highly striking element: the fact that both Iraq and Vietnam appear to be moving in close coordination. The probability of two entirely separate nations suddenly showing parallel revaluation data on major U.S. bank terminals at the same exact time is statistically remote. The concept of a basket currency adjustment, where several fundamentally undervalued currencies appreciate together to stabilize the global trading environment, has been a long-circulated idea among theoretical economists. In that broader context, synchronized changes between the dinar and the dong make compelling strategic sense. This suggests a deeply coordinated effort, perhaps the very early phase of a much wider monetary alignment designed specifically to rectify long-standing, systemic imbalances in the current global exchange rate framework. Technical analysts also draw attention to the most recent infrastructure changes implemented throughout the global banking world. Major financial institutions have been aggressively upgrading their core systems for instantaneous settlements and for facilitating cross-border digital payments. The SWIFT network, the IMF's ongoing currency stability programs, and comprehensive treasury reviews of foreign exchange reserves have all been quietly aligning their processes over recent months. These are precisely the types of behind-the-curtain operational activities that typically precede any major public shift in international finance. When critical updates cascade through such interconnected systems, internal test environments inevitably begin to display live data streams, sometimes days or even weeks before any public release. This may be precisely the situation that Chase and Wells Fargo personnel are currently witnessing. What would rates like 5.3 IQD and 3.95 VND actually mean for the average person holding dinar or dong? For years, private investors have patiently accumulated small reserves of these currencies, holding out hope for a day when a revaluation would transform modest holdings into significant personal wealth. Should these figures become officially confirmed, even seemingly minor currency amounts could instantly represent life-changing financial value. However, financial professionals strongly caution that patience and independent verification remain absolutely essential. Large-scale currency transitions invariably unfold in structured phases: internal system testing, private institutional settlement, and finally, public exchange. From a broader global perspective, any officially confirmed revaluation of this magnitude would carry colossal implications. Significant oil contracts, international import-export agreements, and large-scale loans indexed in US dollars could immediately require meticulous recalculation. A substantially stronger dinar or dong would dramatically shift purchasing power across Asia and the Middle East, potentially alleviating inflationary pressures in certain regions while simultaneously increasing export competitiveness in others. This move could also indirectly influence the dollar's long-standing role in global trade settlements, a controversial subject fiercely debated in contemporary financial policy circles. For these complex reasons, major institutions proceed with extreme caution, ensuring that every digital system and clearinghouse is fully capable of handling the new data before any public rollout is initiated. Even with the palpable excitement continuing to mount, experts emphasize the need to maintain a sober perspective. Internal bank screens are fully capable of displaying pre-launch values long before any official announcement is made. During historical currency realignments, banks have regularly conducted live synchronization tests that displayed the new rates internally, yet kept them completely inactive for customer transactions. This is analogous to a new website being fully deployed but intentionally kept in developer mode. The critical information is present and active, but the final transaction-enabling button is not yet clickable. In this context, What bank insiders may be observing could genuinely represent the final technical testing phase prior to activation, rather than an active public implementation. The emotional reaction across dedicated online communities has been intense and immediate. For years, firm believers in a currency reset have stoically endured widespread skepticism, prolonged delays, and numerous false alarms. Now, with tangible evidence seemingly emerging from within highly reputable banks, optimism is surging to new highs. However, the most experienced financial analysts are issuing firm reminders to maintain absolute rationality. The global financial system operates solely on verification, not on hope or speculation. When official institutions such as the IMF, the U.S. Treasury, or the central banks themselves release synchronized, verifiable statements that will mark the true and unequivocal turning point. Until that moment, the wisest approach remains calm, deliberate observation, not impulsive, unverified action. Across the complex global financial network, a pervasive silence often communicates more strongly than any official public statement. Over the past several weeks, various monetary institutions have been unusually quiet, which in itself can serve as a subtle signal of impending movement. When large banks upgrade their internal systems, they often impose strict communication blackouts until verification tests are fully complete. That enforced quiet period appears to be precisely where we are now situated. Analysts monitoring liquidity flows have detected subtle, measurable shifts in overnight settlement volumes, an indicator that banks are preparing for the new valuation data to be formally settled across their ledgers. These observed patterns closely resemble what occurs when new foreign exchange values are officially uploaded into international clearinghouses. This does not definitively confirm a revaluation, but it does highlight unusual, synchronized coordination among multiple major global players. Behind these technical system updates lies a far greater narrative, the possible commencement of a coordinated global currency realignment. For decades, many emerging economies have argued convincingly that their national currencies were fundamentally undervalued relative to their actual production output and natural resource strength. A synchronized corrective action could effectively level long-standing trade disparities that have persisted for generations. If Iraq and Vietnam are indeed leading this movement, it strongly suggests that policymakers are aiming to restore economic balance in areas where resource wealth and manufacturing capability have not been accurately reflected in global exchange markets. Such an event would send ripples through global trade contracts, national balance of payment sheets, and even geopolitical strategies. When money values change substantially, power dynamics inevitably follow. Let us briefly consider why these two particular nations might be at the forefront of this profound shift. Iraq has navigated years of exhaustive economic and political rebuilding following conflict and sanctions, yet its massive oil exports continue to anchor the regional energy supply. Over time, verifiable and transparent reforms have demonstrably strengthened investor confidence. A higher dinar would not just financially benefit holders, it would successfully re-establish Iraq as a powerful financial hub in the volatile Middle East. Vietnam, concurrently, serves as the stable manufacturing backbone of Southeast Asia, mass-producing electronics, textiles, and crucial industrial components for the world. Aligning its dong with global parity would provide a significant boost to domestic wages, attract long-term foreign capital, and permanently solidify its standing as a major regional powerhouse. When considered together, both of these stories form the two highly crucial halves of a much larger global financial puzzle. Still, no transformation of this scale can possibly happen instantaneously. International revaluations demand full consensus among the relevant central banks, regional trade partners, and powerful oversight bodies like the IMF and the World Bank. All technical systems must synchronize perfectly to prevent highly disruptive arbitrage, where sophisticated traders exploit tiny timing gaps between different currency platforms. That is precisely why the internal testing phase is so critically important. When Chase and Wells Fargo internally display those new figures, it is likely part of a meticulously controlled synchronization period where the new rates are visible only within secure locked networks. Every data update must successfully clear verification through multiple data nodes before the official numbers are permitted to appear in public-facing interfaces, such as consumer exchange boards or mainstream forex markets. The ripple effects from a confirmed 5.3 IQD and 395 VND would be nothing short of extraordinary. Global commodity markets would likely react and adjust first. Oil contracts indexed in US dollars would suddenly reflect a far greater purchasing power for Iraq, potentially reducing its historical necessity to price exports exclusively in dollars. Asian manufacturing supply chains tied to Vietnam could be forced to renegotiate cost structures overnight. Investors holding equities in companies with high exposure to these economies might experience immediate and dramatic valuation swings. Even major credit rating agencies would be compelled to recalculate sovereign ratings based on the new, redistributed national wealth. In short, a currency realignment of this scale would effectively reshape balance sheets across the entire globe. It is important to remember that the world's financial infrastructure is fundamentally designed to absorb financial shocks gradually. Regulatory institutions maintain built-in safeguards precisely to ensure that if a country's currency appreciates dramatically, liquidity and international trade can adjust without causing global panic. This implies that the transition, if genuine, would almost certainly occur in structured phases. Phase 1. Internal data synchronization. Phase 2. Limited, controlled institutional exchanges to verify conversion accuracy. And Phase 3. The public announcement and final rollout. Observers who understand this precise sequencing realize that patience is not only the wisest approach, it is absolutely necessary to allow the technical system to stabilize before the broader market is allowed to react. Many longtime currency watchers also emphasize the crucial importance of information discipline. During past financial shifts, misinformation spread exponentially faster than verified facts. Scammers attempted to sell counterfeit notes or illicitly collect processing fees from hopeful investors. The best and simplest protection against such traps remains the same. Verify every single update solely through official government or major bank channels, never through private, unverified. Meanwhile, advanced technology is quietly revolutionizing the way currencies move. Instant settlement platforms, blockchain-verified ledgers, and sophisticated AI-driven compliance tools have collectively reduced the intrinsic risk once associated with rapid valuation changes. Just 10 years ago, an event like this might have caused catastrophic systemic shock. Today, advanced algorithms handle complex recalculations in mere seconds. That essential technological cushion may be the reason institutions are now confident enough to test live rates internally before making any public declarations. The financial infrastructure can now successfully handle a profound transformation that once seemed entirely impossible. So, where does this leave holders of the Iraqi Dinar and the Vietnamese Dong? For the immediate moment, the wisest and smartest move is observation, not action. Keep your physical currency secure and absolutely avoid any private exchanges until official, confirmed rates are publicly published. Closely monitor official updates from each nation's central bank, as well as credible established financial news outlets. Remember, genuine policy shifts are invariably accompanied by verifiable documentation and perfectly synchronized announcements across multiple countries. The calmest, most disciplined participants are almost always the ones who ultimately benefit the most when the transition is fully complete. If this truly marks the beginning of an international rollout, the coming weeks could define a pivotal new chapter in modern economic history. A stronger dinar and dong would fundamentally symbolize a world in which emerging markets successfully claim their rightful place alongside traditional financial powers. It would demonstrate conclusively that resilience, comprehensive reform, and responsible resource management can absolutely restore a nation's value on the global stage. For those watching closely, every small update from this point forward could serve as another piece of critical confirmation that the long-discussed realignment has in fact begun. Until formal official statements are released, caution and verification remain the words of the day. Still, the undeniable convergence of system upgrades, synchronized bank screens, and concurrent policy moves creates a financial picture that is simply too cohesive to dismiss. Something truly significant is clearly unfolding behind the curtain of global finance. Whether we eventually label it a revaluation, a reset, or simply a long overdue correction, the overwhelming evidence points toward motion, not rumor. The next official announcement may finally transform speculation into absolute certainty. As we conclude this report, one truth must stand above all others. The financial world rarely changes in broad daylight. Most revolutions commence quietly inside servers and spreadsheets long before the screaming headlines catch up. Right now, somewhere in that quiet, the figures 5.3 IQD and 395 VND are indeed flickering across internal bank monitors, serving as powerful symbols of possibility, and perhaps even of a new, more balanced era in currency valuation. Stay watchful, stay fully informed, and stay steady. The core story is not over. It is simply entering its most critical final phase. Hold on to your seats, Dinar community, because today we are diving deep into one of the most astonishing updates in recent financial history. Unconfirmed but widespread reports have emerged showing a 1-to-1 rate for the Iraqi Dinar, $1 USD per IQD, appearing across multiple banking and major trading platforms, sending immediate ripples of chaos and excitement throughout global forex markets. This is far beyond mere speculation or an unsubstantiated online rumor. Multiple independent financial systems reportedly reflected the exact same figure, instantly sparking widespread excitement, intense curiosity, and passionate discussion among long-term investors. The implications of a 1 dinar rate are simply enormous, and this leak could mark a historic turning point for Iraq's entire economy, international trade relations, and the financial lives of every dinar holder who has waited patiently for many years. In this video, we will break everything down clearly and step by step, meticulously exploring where this leak originated, why it carries such weight, and how a move like this could fundamentally affect the global financial system. By the end, you will completely understand why the world is suddenly paying intense attention to the Iraqi dinar in ways it hasn't done in decades. Earlier today, images began widely circulating online showing the Iraqi dinar listed at a 1.0 USD value on various internal banking systems. While minor rate leaks do happen occasionally, what makes this specific incident so unusual is its verifiable consistency across multiple, separate platforms. Normally, a figure like this would be quickly dismissed as a temporary placeholder or a system test value. But in this instance, the number remained visibly accessible for several hours, with its appearance reportedly confirmed by various financial institutions across both the United States and Europe. Banks utilize pre-release environments to rigorously test new rates, ensuring perfectly smooth integration before any public activation. The fact that this particular figure appeared within these controlled systems without being immediately deleted suggests something far beyond a simple error. It strongly points toward a coordinated preview of an impending official update, signaling that Iraq may be definitively ready to reveal a new, much higher standard for its currency. For dedicated dinar holders, this leak represents the precise kind of substantive confirmation they have been waiting for, indicating that their years of perseverance may finally be yielding concrete results. To truly grasp the immense gravity of this leak, consider the dinar's substantial historical change. For numerous decades, the dinar's official exchange rate has hovered around 300 per US dollar, with only infrequent whispers of smaller, minor adjustments, but never anything this dramatic. A $1 dinar rate would represent a total, systemic revaluation, not a gradual minor correction. If this rate were to hold true, it would be equivalent to granting the currency equal standing with one of the world's most stable and strongest economies. Such a monumental change would not merely affect Iraq internally, it would send powerful ripple effects throughout global markets, particularly impacting the oil trade and international investment dynamics. Investors who had previously dismissed the dinar now have a compelling, concrete reason to pay very close attention. The sudden synchronized visibility of this rate in trusted, internal banking systems underscores the seriousness of Iraq's recent financial reforms and its explicit intention to fully integrate its economy with international markets. The implications for massive wealth creation and long-term economic stability are profound, potentially marking an unparalleled moment in the country's modern history.